So basically, what is an interest rate?
In banking and finance, an interest rate is a percentage connected to borrowing or saving money. An interest rate helps determine how much extra money may need to be paid over time. Interest is the real extra dollar amount people actually end up paying on top of the original borrowed money. The interest rate is the percentage used to calculate that extra money. Interest rates are commonly connected to things like credit cards, loans, mortgages, and savings accounts. For example, borrowing $10,000 with a 5% interest rate may cost much less over time than borrowing the same $10,000 with a 15% interest rate. That's why interest rates can be very important when people compare loans or credit cards. In everyday life, many people accidentally confuse interest rates and APR because both of them are percentages connected to borrowing money. That's why the difference between them is not always immediately clear. Very simply explained, the interest rate helps calculate the basic borrowing cost, while APR tries to show the overall yearly borrowing cost more completely. APR may also include certain fees or additional borrowing costs connected to the loan. That's why APR is often slightly higher than the basic interest rate. That's why many people carefully compare both interest rates and APR before borrowing money. Even small percentage differences can become very large money differences over time. So basically, interest is the real extra dollar amount people actually end up paying on top of the original borrowed money. The interest rate is the percentage used to calculate that extra money.
So basically, interest rate versus APR.
In banking and finance, interest rates and APR are related, but they are not exactly the same thing. Because both of them are percentages connected to borrowing money, many people accidentally confuse them in everyday life. Very simply explained, the interest rate helps calculate the basic interest, while APR tries to show the more complete yearly borrowing cost. For example, someone borrows $10,000. The interest rate is 7%. The APR is 9%. This does not mean that 7% plus 9% equals 16%. That is very important. Instead, the 7% is the basic interest rate, while the 9% APR may already include extra fees, loan costs, yearly costs, loan origination fees, setup fees, application fees, and other borrowing calculations too. Now let's look very simply at what may happen after 3 months. If we calculate based on the 7% yearly interest rate, 7% of $10,000 would be about $700 over a full year. 3 months is about 1/4 of a year. So very simply explained, about $170 to $180 interest may have been added after 3 months. That is the interest cost, meaning the extra money charged because of borrowing. However, the APR may be 9% because the bank may also have added fees, account costs, loan origination fees, setup fees, application fees, or other borrowing-related costs too. That's why, after 3 months, there may not only be about $180 in extra interest costs, but perhaps about $250 to $300 in total borrowing costs. So, the normal interest rate calculates the basic interest, while APR tries to show the more complete borrowing cost. That's why people often say APR often gives a more complete picture of the yearly borrowing cost. And that's why APR is very important in real life. So basically, interest rates help calculate the basic borrowing interest. APR is a broader yearly borrowing percentage that often includes the interest rate, plus additional borrowing costs and fees.
So basically, what if the world's money was shared equally?
Have you ever wondered how much money each person would get if the world shared everything equally? Well, the answer actually depends on what we count as money. If we imagine that everything could magically be turned into money, including houses, land, company ownership, stocks, businesses, gold luxury items, and investments, then the number becomes surprisingly huge. In that theoretical situation, experts estimate that each person on Earth could end up with roughly $50,000 to $100,000 per person. But here's where it gets really interesting. Most of that money is not actual cash. A lot of it is connected to things people own. For example, houses, factories, farmland, company shares, businesses, and investments all have value, but they are not simply piles of cash sitting in a bank account. So what if we only counted liquid money instead? That would include things like cash, money in bank accounts, and easy-to-spend digital money. And we do not count houses, land, companies, stocks, or investments. Then the number becomes much smaller. In that situation, experts estimate the amount could be closer to about $5,000 to $15,000 per person, which surprises many people. Because the world feels extremely rich, but a huge part of that wealth is not sitting around as spendable cash. So, basically, even if the world shared all its money equally, the amount per person might still feel surprisingly small.
So basically, APR versus monthly payments.
With many normal loans like car loans, personal loans, or mortgages, the bank usually calculates everything at the beginning. That often includes the monthly payment, how many years the loan lasts, the APR, and the estimated total amount that may be paid back over time. For example, a loan agreement may already say $18 per month for 6 years with an 18% APR, and the bank may already show the estimated total repayment amount before the person signs the loan agreement. So, in many normal fixed loans, the repayment schedule is usually very clear from the beginning. At that point, the person mainly has to decide whether the monthly payment and the long repayment period realistically fit their life and budget. Because even if $250 per month sounds manageable, 6 years is still a very long time. But borrowing money can become much trickier in situations where the repayment time is not fixed from the beginning. For example, credit cards, revolving debt, minimum payments, variable APR, or late fees. In those situations, people may not know exactly how long repayment may continue. And that is where APR can become especially important. If the APR is very high, interest and fees may keep getting added over time. That can make debt shrink very slowly. In some cases, a large part of the monthly payment may go toward interest and borrowing costs instead of reducing the actual debt very much. Some people keep making monthly payments for years while still owing a large amount of money. And because there is no one clear final repayment date from the beginning, the debt can start to feel almost endless. People can easily start to feel trapped in an endless cycle of monthly payments while the debt disappears very slowly. And because minimum payments can look small at first, people can easily underestimate how expensive the borrowing may become later. That is why it is very important to carefully look at both the monthly payment and the APR before borrowing money. A low monthly payment does not always mean borrowing money is cheap. So, basically, monthly payments show how much money gets paid regularly. APR helps show how expensive borrowing money may really become over time.
So basically, what should people check before getting a credit card?
Before getting a credit card, many people only look at one thing: how much money can I spend? But the most important details are usually hidden inside the credit card terms and conditions. One very important thing to check is the APR. APR stands for annual percentage rate. APR helps show how expensive borrowing money can become over time. A higher APR usually means higher interest costs later if the money is not paid back on time. Another important thing is the payment due date. Many credit cards require at least a minimum payment every month. But paying only the minimum amount can sometimes keep the debt growing for a very long time, because interest may continue getting added. People should also check late payment fees, annual fees, penalty fees, balance transfer fees, cash advance fees, and other extra charges. Some credit cards may look attractive at first because they offer rewards, cashback, or travel points. But sometimes the hidden costs can become much more expensive later. Another important thing to check is the introductory offer. Some credit cards advertise things like 0% APR for 12 months. That may sound very attractive, but after the promotional period ends, the APR can suddenly become very high. And if the balance keeps growing, the interest can keep growing too. So, basically, before getting a credit card, people should carefully check the APR, fees, payment rules, and how expensive the borrowing could become later, not only how much money the card allows them to spend.